Hyderabad now?
Yes, we are in Hyderabad, Satya.
Sorry,
Great.
I think meeting is being live streamed now. So
I see Radha also. So
Hi, Dr. Ramesh, Amitabh Srivastav. We met a long time ago when I was with the IIM Fund. No, when I was with the India Science Venture Fund.
Yes, yes.
hi, Amitabh.
Hi.
Good to see you.
okay, I think let's begin. Mugdha, I think others can join in as we speak. Yeah.
So good evening, everyone, and welcome to today's session. Today is a panel discussion on the art and science of venture fundraise by startups. And we have a very eminent panel today. I hand over to Dr. Satya Dash and Dr. Premnath to handle the panel. They will be moderating today's panel and requesting them to take it ahead.
Okay, thank you, Mugdha. That was short and sweet. If you unshare, I already see Radha, Mukesh, Amitabh, and Dr. Ramesh. So we are in midst of friends. And I think Mukesh has a very nice bookshelf in the back. The other backgrounds, or Dr. Ramesh's background is also good. So, and Radha as well. I mean, Radha, last webinar we did, you had a fabulous Zoom background of a library, I think. So
yeah, so this is more of a canned one for the fund. So,
and I love the very simple, minimalistic July Ventures branding of Amitabh. So there we go. Let's get started. I have a couple of slides to kind of prime the AIM Prime, and then we will take it from there. Hold on, I was making these slides this morning. Okay. Okay, can you see it? Yep. So I believe this is being for the AIM Prime cohort. So welcome to the cohort of startups, incubator leaders, as well as academic innovators. And we also have an audience, I think, perhaps joining through YouTube and Facebook Live and all that. When Premnath and I were thinking, for AIM Prime, what this discussion should be for 90 minutes to close to 2 hours, the first bit that I and Premnath are running was about an interface with startups themselves, right? And the second session, which is today, we wanted to have the interface with venture funders, and you will know why, because they are critical. Funding is oxygen, as I say, and but the conundrum, I've used the word conundrum. I think it's a nice word, but I know people on the other side of the table, the funders, I don't think for them it is a conundrum, or maybe it is. We'll get to know from them. And what we wanted to have was a panel who have seen it all, who have seen funding, who have seen exits, who have seen co-founders, who have seen co-founder issues, boards, all that, right? And we also, my partner in crime is Premnath, as you know him already. And we just quickly give the panel an introduction. As I keep on saying, we're amongst friends. I know them, all of them, I think, definitely over the last 7, 8, 10 years. I'll start with Radha. She is partner of Unitas. And one common theme of the panel, except for one, almost all of them are engineers or doctors, and one belongs to international business and mergers, that is Mukesh. So Radha is also an engineer, and then she was with Texas Instruments before transitioning into finance, and then she has been with Unitas for close to a decade now. And so welcome, Radha. Amitabh is again an engineer, but quickly transitioned into the world of finance a long time back, and has had several roles over the last 20, 30 years, working with multinationals like Infosys, then moving on to becoming an investor himself with Indian Angel Network. And then now he's the managing partner of July Ventures in Bangalore. Dr. Ramesh Pairapaneni is the real doctor. He's a cardiologist. And again, has been with the healthcare for a long time, as well as the co-founder of an hospital network in Hyderabad, set up the TIE, the Hyderabad Angels, and has been with India as the managing director. So welcome, Dr. Ramesh. Mukesh is Mukesh Sharma. He is the True Blue CFA, CA, and commerce, all of that. He was with Al Qudra, where he managed a PE portfolio in Abu Dhabi. Then he was founder of a couple of venture funds like Vija Capital. He was the CFO of Willgrow, and then became the co-founder and MD of Mentera Ventures. So welcome, Mukesh. And I must say about Mukesh that in the last 10 years that I've known him, I don't know what he eats or what he exercises, he's stayed the same. Okay. Now coming to Premnath, my good friend. Premnath again is an engineer, chemical engineer at IIT Bombay, then MIT PhD in polymer science. He is an all-rounder. As you can see, he's a moderator and he's also a panelist. So he will follow the Heisenberg uncertainty principle. So you wouldn't know where he is until you hear what he says, right? So so Premnath, welcome Premnath again. It has been a pleasure to welcome you all.
Yeah.
I was thinking, this Premnath, I'll give you 2 minutes. Just let me run through this, another 2 slides.
Sure. Yeah.
This is the wonderful world of Venture Center. Those of you who haven't seen it, you just lose your heart there. Those who haven't, please come and visit. This is for the Indian and the global audience. You can see the wonderful team. That yellow building in the middle row, bottom, is the nerve center. I hope that it still is the canteen. And that's where, that's where everybody comes in all the time, is buzzing all the time. The next slide I was thinking is, last few months we have seen, doing something in Mars. We have a string of people going into space, even though it is like 60 miles, it's okay, it's still space. And I was reading a blog and it said, even rocket launches need funding, right? And then I thought, why not I look at, one of the prime movers of automotive as well as rocket launches these days. And this picture on the top left is actually not far. It's 200 meters away from my apartment in Berlin. It's a Tesla store in the main shopping street of Berlin. And if you look at Tesla's own journey, and I kind of looked at it this morning. So do not, please do not do any business or investment decision based on my next 30 seconds. This is just from the internet. But you can see how it has gone, right? From 2004, when they had a 7.5 million Series A, all the way to, when the Series C in 2006, up to $40 million. And you can see the kind of, funders that have come in, right? Including Google and Larry Page and Sergey Brin. They went on to have debt finance. All these terms, I don't know. I think our panelists know it. And finally, also, there is a bit of interesting bit. They had a loan from the Department of Energy, close to $400 million from the US government. Then they had an IPO. Post-IPO, they've also done partnership with Toyota, Daimler, and many other rounds of debt finance. And finally, I was tracking them to 2017. They had an investment of 10 cents, right? So this is in 16 years of their journey. Big is something very close, and all of us know about Big. And in the last 7-8 months, there have been a few investments in those who have come out of big, and I've listed here 4 or 5 of them. So one is Pandorum that has just raised, last summer, it raised close to 41 crores. Recently, Cygenica raised $1.4 million. And I know both Pandorum and Cygenica advised them. I also see Doji just raised in July 44 crores. Aha Immune raised, I don't know, it's an undeclared sum of money. And I also see Axio that also raised quite a significant amount of money. So we do see a few investments happening, and it'll be interesting to hear what the sentiment is like in the market these days. When we were designing big, this is the report in about 7, 8, 10 years back. We we would like to see many of these happen, but actually products come into the market. So Pandorum and Cygenica are really biotech, tissue engineering. Cygenica is drug discovery. Doji is hardware plus remote monitoring. Aha Immune, again, is the novel molecule, maybe a repurpose, I don't know, I'll have to check. And Axio as well is in medtech, right? I'll stop here. I'll ask Premnath to give it his 2, 3, 5 minutes, and then we will start the discussions.
Okay, welcome everybody. Welcome from Venture Center. And from my side, let me also, first of all, thank you for joining, but also, it's great to see all of you here. And there's a lot, this particular group out here, there's a lot of variety in experiences, and I thought we should draw upon that for the benefit of the audience. But first of all, for all the panel participants, let me tell you that the audience consists of startup founders on one side. There are some faculty entrepreneurs, and then there are some incubators, managers as well. Okay, and of course, there are also people from the larger Venture Center extended community and AIM and so on and so forth. I noticed. I noticed that Chintan is also here. So, Chintan, do you mind coming on video and just a hello to all of them so that people are also familiar with you? And there will be occasions when they will run into you, I'm sure. So that's Dr. Chintan Vaishnav out there. Dr. Chintan Vaishnav is the new mission director of the Atal Innovation Mission in Niti Aayog. So you will probably be running into him in some places. So I thought I'll introduce you as well. Thank you, Chintan, for joining in. Yeah.
Thanks, Premnath. Yeah. I'm sorry, I meant to join more sessions, but I've had to listen to them in non-real time. So
sure.
Glad to be here.
No, but I think thank you so much for joining in. Yeah.
Okay. Thank you, Chintan.
Now, let me tell you a little bit about, in the panel, there are people who have experiences with different types of investments and funding. There are people who have been in the impact investment world. There are people who have spent time with the angel investing as individuals, with family houses, with angel networks, with venture capital firms. We have one PE fund also, XP fund. I'll represent the seed funds from an incubator, and of course grant funding and innovation funding, which Satya also brings to the table. Besides the fact that people like Dr. Bhairapaneni and others are on several committees, very often reviewing cases in government committees as well. So thank you very much. And I think we can cover a lot of ground today. So let's get started right away. I don't want to delay it too much. The kind of the focus here today is on science-based deep tech startups. But that said, we will draw upon your experiences from other sectors also to try and give insights into how the investment world really works. So forgive us if we will start with some of the simple basic elements. Okay. So Satya, do you want to get started first, and then we can go to the first segment of this session?
Okay, I think we have done the personal introduction. Let's just get started about the fund. What they represent. How they're looking at the fund portfolio. So let's get started with that. And I think I'll toss a coin. And or Prerna, did you have something else in the mind to start?
No, I think let's request each of them first to introduce the kind of fund that they work with or past funds they were associated with, and the nuts and bolts of how it works in a very brief capsule, because many of the participants here might be getting introduced to the investment world for the first time. So if you can help us with a 101 of the investment world, early stage investment world, especially from the funds that you run, and what is the thesis behind it? What are the ticket sizes? What do you invest in? What instruments do you use? How do you prioritize things in brief segments, please? So shall I start? Maybe Satya, yeah, go ahead.
Sure. So I'm Radha. I'm a partner with an early stage technology venture capital fund called Unitas. Unitas has been investing in India for the last 8.5, close to 9 years. I've been with them for the last 8 years. We've deployed capital across 2 funds, and we're currently completely deployed out of our second fund and kind of transitioning into the third fund in between 2 funds, actually. What we do is typically write, we used to for a very long time write the first checks into companies. So we were the first institutional investors in startups, and I think all of us might have seen how things have transitioned. We used to write seed checks all the way from about 100K or even 250K USD to now mostly writing about $1 million in first check. And the first checks now are not necessarily all by us. We typically also like to syndicate. In fact, we are investing, for example, alongside of Dr. Ramesh in India in a deal as we speak. We've invested with Mukesh at Mentira on a deal a few years back. So we do work with other investors. We like to work with other investors and syndicate our checks into deals. And our focus areas are actually 3. In fact, I think, to be honest, we are seriously looking at going more deeper in one of the sectors that we have been investing in across over the last 8 years. So we've been investing in 3 major areas: fintech, which is of course financial inclusion and financial services startups; health tech startups. This is more healthcare, not biotech. And then the third, which is what we call job tech, which is more around solving for jobs and the future of jobs, upskilling, reskilling, and those kind of startups. We really look for startups that have India scale, solve for India and what we call India 2 first, but which have the opportunity to kind of scale globally. And this is, I think, very relevant, especially for healthcare startups, where the opportunity is always, almost always global. So I think maybe I will stop there.
Radha, can you tell us a little bit about the origin of the fund? Where is it from? What kind of a structure is it?
So we are for-profit. I mean, we invest in for-profit startups. We make equity investments, and we take stakes in companies. These are, when I say stakes, we basically invest capital in return for preference shares that are offered to us from these companies, which is the shareholding we have in the companies each time we invest in the companies. So we started I think we continue to be that. We are what you call the financial first impact investors. And what that really means is that we look for startups where the impact is built into the business model. So what that will mean is, as the company scale and the business scales, the impact also scales. We, for example, in the case of healthcare, we would be investing in startups that are providing for affordable rather access to affordable quality healthcare. And this will mean that it will help solve for healthcare challenges in tier 2, 3 India. It will help solve for healthcare challenges that are faced by the urban poor or the middle India mostly. So that's kind of the broad brush for what we call impact. And of course, we are looking for startups that are fundamentally, financially very, very sound. They have to be profitable, sustainable, and high growth startups.
Okay, thank you, Radha.
Yeah.
Satya, can I go to Amitabh next? I think, if I'm not mistaken, we lost Mukesh over there. So,
yeah, I think his screen is frozen.
Yeah. So, Amitabh, you're next. Can you tell us a little bit about your latest venture and, of course, your previous adventures with angel investing, IIN fund, and all of that, please? Yeah, and also maybe a little bit about the difference between how each of these works. Yeah.
Sure. Thank you very much for the introduction. My name is Amitabh Srivastava. I'm really very happy to be on this panel along with all my fellow panelists. Just one, you mentioned that I have been involved with both the Indian Angel Network as well as the IIN Fund. This journey has been for almost 14 years, but I've also started about 6 different companies over a period of 30 years, 3 of which have had a decent amount of exits. So I've sat on both sides of the table, raising money at the same time, trying to, raising money also is involved in the fund as well. So July, we're basically sector agnostic. We're a Cat 1 with SEBI. We're sector agnostic. The name July, many people ask me, and since you asked that question to Radha as well, so we like to call ourselves as rainmakers. And July is a good month for rainmaking for many of us in India. So that's how. So that's a false story. Okay, July just happens to be a good name, and the website was available, so we chose that to be our fund name. So we're a state-specific, sector-agnostic. When I say sector-agnostic, there are some sectors that we don't sort of do real tech, realities, and properties, and those kind of things we don't do. But pretty much everything else that that's out there that leverages technology. So for us, the criteria for looking at a company is it addressing access and aspirations of the people, whether it's in health tech or retail tech or education or fintech or a horizontal like a development platform and all of those. So the partners that we have are people who have been hardcore technologists themselves, have worked for large companies, so they've seen scale. We've started a few companies and we've done investing. So across all the sectors, we're kind of okay, but we look for companies that are addressing the access and aspirations of the next billion globally. We look for deals that have a targeted offering, which are natively digital, asset light, tech efficient, built for India, built for world, and so on and so forth. So it can be across any of those sectors. Have I missed out anything else, Premnath?
Yeah, I think I missed out that Amitabh led CSIR Tech. So he's deeply aware of what are the issues in engaging with research institutions and with entrepreneurs and technology emerging from research institutions. So I'll pick on that a little later. So, yeah.
Before we move on, actually, yeah. Amitabh also has invested in Copper Chimney, which I really like.
We got an exit. We got an exit in 2008, so we're out of it.
Right. Okay, great. Let's move on, Premnath.
Yeah, sure. Thank you, Amitabh, and I'll come back to draw upon your experience. Let me move on to Mukesh now. Mukesh, your computer had frozen, so otherwise I was going to pick on you first after Radha. Yeah, Mukesh, tell us a little bit about Mentera and also some of the other things which you're involved with, including some of the investing that will grow was doing, and a little bit about how those things work and how are they different. How is Mentera different from rest of the Willgrow for investing activities, or what you have been doing in the past? Sorry, we can't hear you, Mukesh. There's some sound issue. Can you see if you're muted? Just 1 minute. Let me see. You're muted, I think. Okay. Can you just, are you?
Can you hear me now?
Yeah, I can hear you now. Little louder, please. Yeah, go ahead.
Yeah, okay, great. Yeah, so many of you would have come across Willgrow. Willgrow is a not-for-profit incubator. It was started in 2000, almost 20 years ago, working with very early stage innovations, social innovations, started as a social impact incubator. So I was a chief investment officer at Willgrow, and my mainstream investing work that Satya talked about in global markets out of Middle East, investing in different countries. But I think the Willgrow experience helped because we worked with many early stage companies almost from the idea stage. And we provided them grants up to 50 lakh rupees. This was almost 4 or 5 years ago. And we saw a big gap. Outside of microfinance, sectors like agriculture, education, healthcare, these sectors did not have enough capital to scale businesses. And that is how Mentera came into the picture. So Mentera, we launched it in 2016. Mentera is a SEBI registered venture capital fund, registered as an impact fund. So we are an impact investor. We invest in healthcare, education, and agriculture. Our investment and impact agenda is very specific. So in agriculture, we focus on companies that are increasing income of and addressing the severe impact of climate change on small farmers. In healthcare and education, we are focused on delivering high quality products to the underserved communities. So quality of what is being offered, access and cost are important dimensions for us. To make a big dent in the lives of millions of poor, we believe that we need to move beyond linear thinking and incremental innovation. So non-linear outcomes, we believe, are more likely to be achieved through big game-changing ideas that leverage the latest in science and technology. And therefore, we are looking for high-quality businesses that are able to use power of innovation, technology, and entrepreneurship to solve big problems at a serious scale. In pretty much all of our companies, except for one or two, we are the first institutional investors, and we expect that to continue to be the case. We usually start around 1 or 2 crore rupees ticket size, which is increasing now as the amount required to scale technology businesses is also increasing. So about 5 crores is our starting ticket size, and maximum we have done so far in the company is 10 crores. Prerna, is that
yeah, maybe a couple of examples of some investments, which I think you have also exited some.
Yes, we've exited from 3 companies, but I would talk about probably a couple of technology companies that we created almost from idea stage. So Biosense Technologies, those of you who are involved in healthcare would have come across. This is a company that we started working with when they were DOM startup in IIT Bombay. 2 of the 4 founders were still completing their studies at IIT Bombay. So we incubated them through Willgrow, and then we provided them 2 rounds of equity capital from Mentera, and also helped arrange soft debt funding for them. This is a company which was acquired by PerkinElmer, which is S&P 500 listed company. Their Indian subsidiary acquired Biosense 1.5 years ago. So this is a complete almost 8-year cycle from idea stage to complete acquisition. One of the very few complete acquisitions that you would see in this space. Satya, maybe next time you talk about big, you talk about acquisitions also in addition to funding. So that's Biosense. Adivo Technologies, another company that we spotted through our business plan competition that Willgrow does. They operated out of Willgrow's office in Chennai, and very close mentoring even before we provided them any kind of funding. And then of course they went through the cycle. We provided them grant funding through Willgrow. BIREC, funding came in, and also, now 2 rounds of equity funding through Mentera. Prerna, back to you.
Okay, great. Thank you very much. Let's move over to Dr. Bhairapeneni now. can I request you to speak a little bit about India Partners and your new fund as well as some of the kind of companies that you're looking at. Of course, later I will ask you also about how you think about deep tech startups when you're looking at some of the proposals coming to you.
Sure. Thanks, Satya. Thanks, Premnath, for putting this together. As Satya mentioned, I'm a cardiologist, practice.
Sorry, we are losing your voice. Can you cut off your video
For the
for
last
a moment?
10 years almost.
Yeah, let's see. If you can try cutting off your video.
Sure. Is this better?
Yes, much better. Go ahead, please.
Sure. So for the last 8 to 10 years, I'm in the investment side. Initially as an angel investor, I was an angel investor in Nephroplus, India's largest dialysis service provider. And we started this fund, India Partners, in 2015, a small fund, $30 million fund. And in 2020, we started Fund 2, $75 million fund. This is both a healthcare fund as a tech fund. When I said tech, more on the digital transformation and on the deep tech. On healthcare, we are mostly in digital health, a little bit on the medical devices, and a little bit on the life sciences. When I say deep tech, other than the healthcare, someone developing a chip for artificial intelligence, someone developing a 4D imaging radar chips for autonomous vehicles. And we say digital transformation, this cuts across industries, whether it's healthcare, whether it is fintech, whether it's HR tech. Coming back to our own fund, healthcare investment, probably I limit myself to healthcare, Premnath.
Yeah, sure.
This investment is probably the participants are mostly from healthcare. We have one investment in the life sciences called iStem, developing a pluripotent stem cells for a disease with no known treatment, advanced dry type of advanced macular degeneration, AMD. And again, as this is a pre-revenue company, still in animal phase, I just want to bring out because we go that early if there's a compelling indication. And the second one, I would like to bring out a couple of them. SigTuple is using AI in pathology. It is both a hardware as well as a software. Because pathology images, as all of you know, 99% in the world are still in analog mode. They're not in a digital mode. So that means you need to solve both the digitalization part as well as the AI part. So it's a combination of hardware, robotics, and software. Already got 2 CE mark for peripheral blood and urine, and we are on the path to submit the FDA in the next few months. The third company is again similar to the second, is Synapsica, a teleradiology platform in improving the workflow, productivity of the radiologist, as well as using some AI tools, not a complete AI solution, again to improve the productivity. And I think these are 3 or 4 examples I want to bring. Probably at this stage I'll stop, unless Premnath, you want me to dig further or wait for the next round of questions.
Sure, I think this is good. Let us continue the discussions and we'll come back further. Yeah.
Radha said we are more a seed pre-series A investors. In our terminology is anywhere from $500,000 to $2 million. And it happens, most of them appears to be the first check because these days $100,000 checks have disappeared. This pre-seed or pre-series A is becoming $500,000 to $2 million checks.
Mm-hmm. Sure. And are these companies which are at pre-revenue stage or revenue stage?
Most of them are in the pre-revenue stage. Probably in the product development. SigTuple is a pre-revenue. Synapsica is a revenue. So revenue doesn't make, it's not a really, the product is good, almost on the verge of getting regulatory approvals, we are ready to go. Need not have. Yeah.
Okay. Can I request you and also Amitabh to comment on the angel investment world versus the VC fund world? Both of you have been involved in both of these. right? Can you, and of course, there's angel investment, there's angel networks, and then there is VC fund, right? So would you like to talk a little bit about these three and sort of compare them, contrast them? Tell us, how should a typical startup look at each of these, and what do they bring to the table differently?
Dr. Ramesh, you want to go first?
Yeah, please go ahead.
No, you should go ahead first.
Sure. So obviously, angels are obviously individuals who write the first check. And that used to be probably until 2012-13, when the angel network started forming. The first one probably either was Mumbai Angels or Indian Angel Network. And after that, Hyderabad Angel Network, we formed in 2012. So Angel Network is a group of people, usually anywhere from 20 people to 40 people in each network, whether it's IAN, whether it's Mumbai Angels, Hyderabad. Probably there are dozens of angel networks in the country. They're loosely configured as on today. Maybe there's one more subset is there called angel fund also, as for under like the IAN fund.
Yeah.
SEBI has given permission from angel fund also. You have the angels, individual angels, you have the Indian angel networks, an angel fund, and early stage funds like us. So this angel network is a informal group of 20 to 40 people in each city. And mostly the startups reach out to them. They have a monthly meeting. And one of the members in that group take the lead in due diligence and taking it forwards. Whereas individuals, when they write this check, they write it on their own. You may ask me, what are the advantages, disadvantages of taking money from an angel fund? Individual angels will leave it for a moment. Indian angel networks or funds. One would probably the angel networks, because people come from different backgrounds and it's not their full-time job. So they don't mind writing a check. One of them may be on your board helping you, but sometimes probably because they have their own full-time jobs. So how much help you get, I'm not very sure. Maybe Amitabh can comment there. But otherwise, I think if someone is writing a $500,000 check, whether it's angel network or early stage fund, should be okay. As long as from the angel network, you get a person who is involved in that. One way is good, they give money and don't disturb you. Whereas funds keep on bugging you every month to give a monthly report, frequent calls. But otherwise, I think most of the angel networks are fabulous. Entrepreneurs have good background. It all depends upon the entrepreneur. In fact, one positive way of looking at it is you have access to multiple angels in that network, and you can always use them for his business development. So you can always argue for taking money from angel networks also. So otherwise, they also do equity, like us, is all CCPS convertible preference shares. Sometimes they do a convertible note or a safe note as promoted by Y Combinator. But otherwise, I think it's probably hardly much to differentiate between a good angel network / angel fund / early stage VC fund trademark.
Yeah, before Amitabh takes over, can I just ask you one quick question, which is that if you were a startup, how would you evaluate who would you go with, an angel network or an IAN kind of one?
I was going to answer. I was going to
pick that up.
But that's a good question.
Let him give his views also, Dr. Ramesh.
Of course.
So if I'm a startup, whether I'll take money from an angel network or a fund, is that the question?
Yeah, an angel, standalone angel, or an angel network versus a fund, right? How would you compare it, and when would you go to each of these?
If I'm starting a startup, if I have to take money, probably I'll take money from 2-3 angels from the relevant field, and then / either angel network or a fund. Probably fund may be a little more, I'm biased towards fund because it's far more structured. Why I said I want to take money from 2-3 angels would be, assuming I'm a life sciences company and I'm a vaccine guy or a biosimilars guy. If I can get the best 2-3 people in the country, in the industry, to put even 10 lakhs, 25 lakhs into it, it shows a lot of confidence when I go to a fundraising mode. So I think I'll definitely prefer to have 2-3 fabulous angels from the domain and then go to either an angel network or a fund. My preference is to a fund, but as I said before, the angel network / fund probably hardly much difference, but definitely I would like to take money from 2-3 angels from the domain.
So if it was vaccines, you would think, yeah, Varaprasad Reddy or Krishna Ella would, if they back you up, probably it adds a lot more confidence in the company. Is that so?
Probably when the investors look at it, it adds confidence. What happens, Premnath, the investors come, obviously you can't expect an investor, even a healthcare investor from a domain, to understand vaccines, to biosimilars, to APIs, to digital health, to medical devices, to MRIs, to ultrasound. So when the investor is evaluating a company, and if that company tells that I'm developing a vaccine and the 2 of the 3 best vaccine manufacturers in the country are willing to write a check, that means my interest level goes up. That means this startup has been evaluated by 2 good angels who understands the domain, and that gives a lot of positivity and a lot of attention when the VCs look at the presentation.
Okay, great. So Amitabh, your turn now.
Thank you. I think Dr. Ramesh has pretty much summed it. I'll just add a few things. So like he said, you can go to individuals. You don't need necessarily to go to an angel group. So you can raise it from the types of angel investors are basically people who are individuals, a group of 2 or 3 people who are sort of friends with each other with different skills. They're open to investing, so you can go to them. Angel groups, as he mentioned, there are several angel groups. The angel fund category, by the way, the ION fund is not an angel fund. ION is a regular Cat 1 fund. So they're like any other fund, like Radha's fund or like your fund. The angel funds are the likes of Anycut today, or Venture Catalyst, or some of those people. That's a different model. And then obviously the venture capitalists. The one difference that I find is that when I'm investing my own money, I can afford to be a little flippant because it's my own money. Yeah. So, if I like the face of the entrepreneur, I just feel like putting the money and I think I'm going to take it forward. But when you become either a lead investor in an angel fund or a fund manager in a VC, the responsibility is that much higher, because now you're accountable to your fellow investors, to your LPs, so it's a little tougher thing to do. When to raise money is one question that you should consider. If you go to my LinkedIn profile in the featured post, there's a set of slides that I put on when you should raise money. So it's important when you should raise money and from who you should raise money. And from who you should raise money, you should just go back and ask yourself just say to yourself, beauty is in the eye of the beholder. I'll repeat, beauty is in the eye of the beholder. Are you going to the right beholder? Yeah, to have your beauty appreciated, whatever is the thing of beauty that you're trying to create. So be careful. So there are several aspects. One is who do you raise it from, and when should you raise both? Premnath, I'll just sum it there.
Mm-hmm. So, by the way, Amitabh, in India, I think the data is that there are more angel investments happening in volume and in quantity than angel network investments.
It's quite possible. It's just that it doesn't get recorded that well. However, if you look at people like Mohandas Pai, outside of his 314 and the other capital, there are many people who still feature in the list of people who contributed in both quantity as well as the quantum of investment. But it's because it's not regulated, they don't. They're individuals, so you don't come to know about it. So it's really hard to say whether angel groups invest more by way of quantity and quantum, or individuals do.
No, Amitabh, I'm saying that actually it's the angels who invest more than the angel networks. And I have data to show that.
Okay. No, I'm saying that, yeah, it depends on the publication, right? Whoever publishes that.
Yeah, no, these are statistics even from I mean, if you look at the overall numbers, the volume of investments by networks is relatively low, right? Although
Amitabh, maybe possibly Premnath is right. For example, I'll give assuming if IAN does 50 investments per year and all other networks will do maybe another 50 or 150. But of late, you are seeing every startup, along with the VC fund, there are 5-6 individual angels also are investing. So if you add all those, maybe numerically, the number of deals where the angels are listed probably will be higher than the number of deals where the network is.
Absolutely. And I can easily believe, I was not at all suggesting earlier that the angel networks do more than the individuals. In fact, out of the 18 different investments that I've done as an angel investor, 8 of them are from IAN, and the rest are in my individual capacity in conjunction with other fellow friends. So those, I don't know whether those get reported.
Yeah. Okay. Are there any differences in the kind of terms you get? And especially, is it so for example, you see founders of Ola or all of those investing, right?
That's a good question.
And also the angel investors, we do see a lot of action, but not, I mean, I don't know for sure, but I don't know how many gets converted, what are the terms, but is there any information on that in terms of what kind of terms can you get, and what are there differences in instruments that people offer?
So I had a view 5 years ago, and it's changed dramatically. I used to think that angel investors are kind of lenient. They don't look into each and every clause, and that the fund managers are they'll look at each and every clause through the tooth and comb. I think that view has changed. I'm not saying that which one is better, because the entire new age investing, because investing has been around, as you know. I invested in Copper Chimney, like Satya mentioned, right? That's old age investing. So in the new age investing, I think the view is that you have to be founder friendly. Okay, just as the founders are looking to raise money, we as VCs are very, very keen to invest money. So when we see a good founder with whom we are going to be in a sort of a married relationship over 5, 7, 10, 12 years, etc., you want to make sure that the terms are very, very founder friendly. Yeah. So obviously, if you are investing in a company where you think that something is going to go wrong, then you shouldn't really be investing. Yeah. So the view, my personal view has changed. In fact, I find that some of the angel, whether they are lead angels, they get into a lot of nitty-gritty and all of that. But I think overall, as an industry, over the last 20 years, since I have seen my involvement with the Infinity Ventures in 2001, since that time, I've seen a lot of maturity which is coming up, and it is becoming very, very founder friendly.
Yeah. Can I just, Satya, just one other question, because you left out one category. Okay. So I wanted to ask Radha and Mukesh, starting with Radha first. How do you look at companies? How do you look at companies which are, say, raising strategic investments when you are putting money in? Would you go with them or not? Right. These are corporate investors who are investing either from their corporate venture funds or looking at investments in a strategic capacity. So it's Radha is there, right? Yeah.
Yeah. I'm there, Premnath.
Yeah.
So just to clarify, you are asking if we would view a strategic investor coming alongside of us at the stage we are investing, right?
Yeah, that's one. The other is if it is before, they have come before you, and also as a follow-on investor later, right? How do you see them? I mean, because, normally there is this tendency that, everybody comes and tells every startup that, find those collaborations to work with big companies and so on and so forth. And they're in a great hurry to do that. But sometimes you have to understand its implications also, right? So I wanted to also bring that perspective down. Like, how do you view strategic investments?
Yeah, so maybe I will kind of break that strategic investments bucket into two. There is one which is actually a proper structured corp VC, right? So a lot of these large corporates have a fund which is where they invest out of, and typically those funds are fairly disconnected from the main or core business. So what I mean is, let's take for example Google Ventures or Capital G. I mean, these are investment funds or investment vehicles which are not investing capital out of Google's balance sheet. Okay, so the reason that is different from strategic investments which are made from the balance sheet is because fundamentally there are two things that will differentiate them. One, it's more likely that if it is from the balance sheet, there will be a lot of overhead in terms of process and a lot of back and forth with the teams, which are mostly the technology product or maybe the specific teams which are potentially then going to be working with these companies. And the challenge there would be that they don't come in with an investor mindset, right? They're mostly looking at it as either an extension of a product, maybe longer term, but just getting some kind of optionality by coming in early, or an extension of maybe the team at some point, maybe acquiring the team or things like that. So just in general, I wouldn't view balance sheet investing as kind of a fund investment, right? It was not the same as that. But if there is a very clear demarcation and there is a fund which is properly structured as an AIF vehicle, if it's in India, or it's a proper fund investing from one of the other formats from outside, like a Cayman fund or Mauritius fund or whatever else, right? Or even a US fund. So I think these are most likely also going to be broader and they operate like a fund. So that is a better thing to pick. I would actually think that that's a difference. For us to look at how do we look at it? See, we like I was telling you, Premnath, we are usually the first institutional investor to come into a company. And that really means that the companies that we invest in at the stage we invest in have not necessarily demonstrated a lot in terms of either traction, as in monetization and revenues, or even in terms of the, let's say maturity of product or service, right? So typically they have a product that is, or service ready. They have some amount of product market fit or proof of demand established. And that can be, kind of demonstrated through maybe revenues coming in. Of course, like Dr. Ramesh was saying, we also have a couple of pre-revenue companies, though we do like it when companies actually come in with, paying customers, which could be a handful of them, but that's still proof of demand. And so what happens is it's still fairly early. So if a strategic were to come that early, to be very honest, I think it's not really very positive. At least we've not viewed it as positive. And the reason is that there are several other implications for it. So one is the fact that there could be potential, question around excluding some bigger other strategics who could potentially be customers or partners for this company. Right, and you're kind of limiting the company's collaboration and business development to a certain segment. So I will give you a non-healthcare example because we saw this happen in one of our companies, which was in the jobs space, right? So basically, in the blue collar jobs space, there was a lot of interest from two competing large behemoths to want to come in and invest. One is Quess. And the other is TeamLease. I think these are names that everybody is familiar with because these are guys who provide you with blue collar staffing for facilities management, security, all of that, right? People you interact with on a daily basis. Now, the company, if they were to actually take money from, let's say, a Quess, you are in many ways kind of truncating potential, customer or interactions or partnership with team leads, which is potentially equally big, or both of them could even get bigger. And there are also eventually questions around you would yourself as a company may end up getting into the same business as these guys, right? I think there are all those larger questions on conflict and things like that, and kind of being excluded that will come up. And so we have usually stayed away from strategic investments very early. But the same thing can flip a little later. In fact, it can be a huge plus for companies when there is a strategic coming in, because it's a huge signal. I would actually take it to the point where maybe both Amitabh and Dr. Ramesh were saying, right? So if you bring in strong, experts initially as angels, that's a big signal. Similarly, if you bring in a very large, domain strategic, somebody a strategic who's very, very big in, let's say, medtech as an investor, or whatever, biotech as an investor, that could be a signal for the VCs. Because that basically says that it has been vetted and there is huge credibility being attached, but coming in a little bit more later. So I think that's something we've supported.
Sure.
I don't
Thank
know
you.
if
Yeah. No. Yeah. That's a good answer. I mean, good points. Mukesh, do you want to add to it? So, Dr. Ramesh, you wanted to add something?
Yeah.
Please go ahead.
Also, it's very unlikely.
Yeah.
Companies you are involved. We are involved. Early stage, pre-series A, series A. A strategic will come in. Actually, very unlikely.
Mm-hmm. Okay.
And sorry, Premnath, just one point. I think as VCs, one of the things I want to mention to this audience is that, we want to invest in companies which individually we think will become really big, right? It is about companies which are going to grow and grow rapidly and give us minimum, like going in, we want to see visibility to get at least 10 times cash on cash returns over the next 5-7 years. Now, the fact is that if there is a strategic coming in early and, there is some kind that might in many ways kind of, I guess, tiny growth, and it might end up meaning that the company is not necessarily going to be able to scale and become a winner by itself also. So I think in some ways that doesn't happen. Like Dr. Ramesh said, at least I have not come across cases where that happens.
It might indirectly depress valuations because of what the corporate wants to do, right?
Yeah.
Okay.
That's also
Yeah. Sure. Mukesh, do you want to add?
No, I think everything has been said, but I think we are all talking about risks and issues of a company coming in. I think there can be huge opportunity also.
Yeah.
And, early stage technologies, dealing with this whole valley of death, all the challenges that one has to deal with, it entirely comes down to on what terms that intervention or that capital or whatever engagement is coming. I would not exclude it for sure.
Okay,
I mean, as an entrepreneur, I will not exclude it. As an investor, like Radha said, if you're trying to make 10x on your investment, you would worry about some strategic coming in early and closing out your options. But as an entrepreneur, you should definitely look at it, but look at it very cautiously and very carefully to not end up agreeing to terms that end up hurting your business.
Yeah. Okay, great. So let's move to the next segment. This was a good intro to all that you're doing, and this is I think a good foundation. So let's move quickly to the next segment. I'll request Satya to take over now. This next segment is more about thinking through how your investment decisions are made and some inputs on, of course, without giving away your secret sauce. So Satya, over to you.
Yeah, no, thank you. I think it's wonderful global view and strategic view that all our panelists provided, regarding strategic investors coming in early, what may happen to that. Let's go to the nitty gritty of our audience, especially our cohort, right? I mean, as all of us know, most of them are thinking, and as Prerna said, this is the first time they're interacting. Some of them may be first time interacting with you, and it's good that they're interacting with you as a group and as investor. So I wanted to go to the second segment in terms of what really happens, right? How do you hunt for, as Amitabh said, in the new age investment philosophy, you are also seeking to fund. You have your basic thesis, your premise of your fund. What is it that you're looking for? What is the admixture of technology, valuation, co-founder, people, all of that mixed together, right? That's the conundrum, the early stage conundrum of interaction. So, can you tease that apart for our young startup, audience here? Let's go reverse again. So let's ask Radha, Mukesh, and then we'll go to Dr. Ramesh and Amitabh. And Radha, especially you and Mukesh, as you said, you are almost the first institutional organization, funder that is giving a check. So how are you assessing, in the first interactions?
Yeah, so I think you will hear this from everybody, and increasingly the check sizes, the first check sizes are just kind of bloating. More recently I read there was this company which raised, I think, $50 million as first check. So clearly things are kind of going in a direction that none of us clearly understand in many ways. But to be honest, I for one really strongly believe that we as investors have already a good understanding of the areas we want to invest in, right? It's not that, for example, as Unitas, we would not maybe go and pick climate tech, or we would not suddenly invest in space tech or things like that. So the reason why we pick these three areas, which is health tech, then what we call job tech and fintech, is because of two. One is, I think, as a team, we are slightly more, we kind of understand these areas a little bit better. We've also made good number of investments in these areas. So we know some of the key challenges, we know how big the opportunities are, we know what might really be a good bet to make based on what we're seeing in the ecosystem in the areas, in these three areas that we're investing in. So fundamentally, what I'm trying to say here is that we have a good sense of the market size and the maybe to say how big the company can get, or the companies or the opportunities in these areas can get. So coming in early for us, one of the biggest things that we look for to make a decision is really the team. And it is very important that we as partnership build conviction around the team. And two things: one, their ability to actually build this business and make it really big. And second, just their vision and maybe alignment with us in terms of how they want to take it forward. So I think, yeah, sorry, I think you had a question.
So team is good, but from the statistics that we see now, a lot of our young entrepreneurs with a BTech, MTech, or a PhD, what are you sensing in the team when you say their ability to build something, but they haven't built anything yet? So what are those strands or threads that in behavior that that you're looking for?
So one or two things that I will maybe talk about. So the first thing is that the entrepreneurs are the experts on the ground, Satya, at the end of the day. So, and in every conversation that we have with the team, we actually might have, the randomest of questions and the more insightful of questions, but their ability to address those questions and the unique insights they bring from the area, from the area that they're trying to solve for, either the customer base, with the technology, the kind of problems they're seeing other people solve, how it's being solved today, what are better ways to do it, and why they're picking the way they are trying to operate, things like that, right? I think their understanding and insights are very, very important. And honestly, all of us are really observing and learning from every one of those conversations with the entrepreneurs. So we want to be sure that they have a good hang of what they're trying to solve. The second thing I think that is that kind of, at least as an individual, I look for is the ability of the team to have to convey and to really believe in a very aggressive and a large vision. They should want to build something big. It is not that they want to take money from a VC and that's like a intermediate milestone, or that can't be a milestone in itself. I think fundamentally they want to think, I want to build whatever, the world's best XYZ or India's largest ABC, whatever, right? And they should mean that, and it should actually come across in those conversations. And I've seen this at least in few of our entrepreneurs, and I think that's very, very big. And then the third thing, which at least once again I've seen, which is very strong, is the ability to listen and take feedback. I think sometimes I've seen entrepreneurs, come back and say things and say, I know what it is, but here's what I'm going to do. But at the end of the day, there is always a feedback that you're getting from everybody in the ecosystem. It may not be perfect, it may not be the best feedback, but you should have the ability to listen, process, and then kind of come back and say, I think I'm doing this because XYZ, right? So I think insights, unique insights, large and aggressive goals and vision, and I think more ability to listen. I think these are three qualities that at least we put very, very high.
Thank you.
Mukesh,
Satya, you're on mute, I think.
Mukesh, would you like to add to that? Thank you, Radha, for that.
Yeah, so I think team part is already covered by Radha, but I'll talk about a few other aspects. But team, we look at diversity, Satya, because tech businesses and in healthcare, you have seen that you need 4 or 5 areas to be covered: clinical, engineering, regulatory, market, finance, right? 4 or 5 areas need to be covered. If you are very strong in one and weak in all others, it's very difficult to create a business out of that. So diversity of background in the team is very important. Many times you would see 4 or 5 colleagues or classmates from an engineering college coming together, all 4 from the same engineering discipline, right? So that doesn't usually help. Because the equity is already spread between 4 or 5 of them, and as you try adding other important skills, then it gets really tricky. So other than team diversity, Radha talked about our understanding. So we interact with many companies operating in different areas within a sector, and because we developed our own thesis on where is the maximum value in that value chain and how the emerging trends are going to support or obstruct the realization of that value, we are specifically looking for models that are most likely to benefit from those value and growth drivers. So compelling business and impact case, these are the 2 things which are non-negotiable for us. If we are not convinced on either of the 2, business or impact case, no matter what else works, I don't think we would probably go forward with that. In addition to that, execution discipline and organization building DNA in the founding team is very important. These are important markers that we look for. And even in very early stage, you can see an evidence to that effect that will they start hitting challenges after a certain level. The third aspect that may not come out in the first meeting, but as we go deeper, we'd probably look at a strong financial discipline. And you talked about valuations, Satya. I'm sure we'll go deeper into that, but fair valuation expectations would certainly attract interest from us. Because while it is important for us where we are investing, at what price we are investing is equally important.
You want me to go?
Sure. Yes, Amitabh, over to you. Amitabh, can I also request you to talk a little bit also about the flow? How do you get applications? What are the volumes? How do you screen them? Also from your previous experience at IIN and so on. And how do the mechanics of it work? And then sort of inside view of it to the extent that you want to share.
Right? No. I think there are 2 things that only increase for you when you give away. One is love, the other is knowledge. So the more I share, the richer I get. So on that note, You're right. I mean, I think there are typically between 3 to 10 meetings from the time you send out the pitch to your time you're called, and finally when the term sheet is issued. There are plenty of opportunities for you to get to know the investor and for the investor to get to know you. Both of them need to kind of know each other. Is it okay if I share my screen for one slide, or
yeah, sure, you can. Just let me give you the right.
It's already
Anmol can. Yeah, okay, good. Yeah, you can share.
Awesome.
Yeah.
Are you able to see my screen now?
Yeah, it's come up.
But it's showing you other stuff, right? Now you're able to see my screen.
Yeah, full screen. Yeah, you can go full screen.
Awesome, yeah. Awesome. Okay, so there are there are a variety of things that one looks at. Let me just add 2 things on the team front. So these 5 things that you see on the screen, they are interlinked. So one is not bigger than the other, but they're all equally important, and you assess each of these 5 over a period of 3 to 10 to sometimes 15 meetings. Okay, I mean, I like to basically cover up everything in 3 to 4 meetings and not really go to 10 or 12 meetings, which is really not useful, good use of the time of the people. So I'll just add 2 things on the team. One is skin in the game. Okay. Many a times we come across entrepreneurs who say that, look, there are 3 partners who are running this. 2 of us are on board fully. One of them will leave Microsoft and join as soon as possible. So you need to have some skin in the game. And I'll just add one more thing, which is the mentorability or learnability. Your curiousness to know more and draw from the experiences of the investors. And remember, go back to the first thing that I said. It's all about trying to figure out, whether you're going to the right investor. So in the team, one of the things that we will want to look at the end of every meeting, today, do I feel, is this the right team to execute the plan and get investors and exit? Not the founders. I'm only talking about us as an investor. Although exit is not something that we look at in the first meeting but it's probably the last thing that we kind of look at, but we kind of try to get a sense of that. We want to know how good you are at teaching us about where the market is. How well do you know the competition? Is there headroom for growth? How good is your intellectual property? What's your pricing strategy? Are you solving the problem, etc.? What kind of traction do you have? And we can talk about KPIs. Even if you are not having financial numbers, you could have other attractions that are out there. You could talk about your loyalty, traction in loyalty, traction in scale, traction in your intellectual property, and so on and so forth. And last but not the least, is there sufficient conviction of IRR upon exit, at least for the investors? So these are the 5 things that I would kind of look at overall from the first meeting, from the first email till the term sheet is issued, which hopefully is not longer than 15 to 30 days.
Amitabh, when you get an email, what gets you to open that email and read it?
Okay, so let me just describe to you the process. So we've kind of agreed amongst ourselves, amongst the partners and the people that work with us, is where does the email come, and who looks at it at first, and then so in our case, we're looking at 1,500 deals to be evaluated over the next 3 years. Out of that, 300 will be shortlisted for a team of 2 or 3 partners who look at it. Out of that, about 30 will come to the investment committee, and out of that, 15 is what we will invest in. Okay, so that's kind of the chain. So you send an email, somebody looks at it, and there is I mean, I can share another screen, but that'll take time. But there are a bunch of questions that people kind of fill out, which gives us an idea of how do they describe their company. Okay, are they going in a roundabout way? What are the valuation expectations? Who's on the cap table? Do you have any debt, which is long-term debt? And what's the sort of skin in the game of the people who are involved? So and like I said, we are sector agnostic, so we're not really bothered about what kind of business, whether it's health tech or any other sector. So there are a bunch of questions that somebody looks at and shortlists on that basis. If there is a deal that comes to me directly, let's say you send me a deal. Now, obviously, I hold you in high respect, so I'm going to make sure that I spend amount of time in looking at it. So the way you write your email, you must share it with your partners, with your friends and others before you send it out. Okay, so make sure that you write very well worded, should not be more than 6 to 7 lines. Everything should be there in the attachment which is accompanying you. So that kind of gets our attention. If you're going in a roundabout fashion, that's not very helpful. If I'm answering your question.
Sure. Dr. Ramesh, maybe you can go next and also tell us what are the different sources of how do proposals reach you? Do you prefer one which comes with a referral or not? What is the mechanics of how you decide, which to give more attention to?
Sure. Like an entrepreneur is anxious to get his startup funded, most of the VCs, most of the investors like us also, we are also anxious to get the good deal actually. So I think, and also as Amitabh briefly mentioned, like in the MBA applications, good applications, when you send, you have to make sure it reaches the appropriate person, even before the interview itself. Because many times if you write a bad CV or a bad email, it doesn't even come up. I think most of the investors, most of the VCs have their blogs written, and every investor is biased. He has own ideas, he has own convictions, whether right or wrong. I think an entrepreneur has to be smart enough to look at the websites, look at the blogs of various investors, and then he knows whom to approach. The second point was, like Amitabh said, if an email comes from Premnath or Satya saying that please look at this company, 100% that investor will look at the presentation for half an hour. So coming back to your specific question, how do we get the deals? One is randomly we get around 150 presentations per month, 1800 presentations per year, roughly. And most of them come randomly. Startups just email to us and they get the least attention, unfortunately. And the second way we get the leads are, we scan all the incubators, accelerators on our own. Our analysts, we look at Venture Center Pune, we look at CCAM, we look at IKP, we look at IIT Delhi or KIT. So we look at talk to your analysts, get the list once in 2-3 months, scan those. The third one, which is the most important, comes through people like you, referrals. Suppose if I'm working in Pune, if I'm working in Hyderabad, if I'm working in CCAM, definitely if someone spends, any smart entrepreneur, if he spends time, they know who is connected to Dr. Ramesh. So using a local person, for example, someone from Indian Institute of Science, if he says this product looks good, definitely they get the maximum number of attention. I think to sum up, we get on cold emails, the largest number, which gets the least attention. And we actually proactively look for incubators, accelerators, their deals. And third one is someone, early stage funds sending to us, or people like you, various incubators, accelerators, or even angels, for example, super angels. Rajan Anandan sends, or Dr. Ramesh, please have a look at this. They get the maximum attention. These are the 3 sources of deals for us, Premnath.
Okay. Satya, before we go to the next segment, can I just quickly request one topic each to just, go ahead. Do you want to say something?
Yeah, you do that. And in the list of the topics that you want to add the valuation part and add one important, the mechanics of pitch deck. What is the right size pitch deck? 60 slides, 20 slides, or 10 slides, right? Let's learn from the from the panel.
Yeah. So maybe what I suggest is, let's go with your first question, which is what do you expect in terms of? So maybe Radha can go first. Tell us what is a good email and content that gets you sort of interested, and what's the size of the pitch deck? What is the size of, what do you expect? I mean, in terms of what would be a nice thing to receive and feel good about and take some interest in a particular proposal?
Yeah, so I think two things. So one, I wanted to tell this audience that before you reach out to an investor, make sure you do some homework about that investor and the investor's portfolio.
Yeah.
I think it is a very fundamental and in fact, a basic thing to do. That will tell you a lot about what the investor's focus is, what kind of businesses do they like. In fact, if you can, I would actually appreciate if the entrepreneur can figure out some common connections either through portfolio company CEOs, or like Dr. Ramesh said, some of the potential referrals who can actually add weight to the email. And like how Amitabh was saying, I think all of us, all my friends and colleagues here are people who get like too many emails on a daily basis. I'm sure you and Satya also do. And at the end of the day, there is only limited time that we have. And so if you want to capture our attention, one, do some homework, figure out the right person that can introduce you. That is actually half the problem solved, to be honest. The second part of it is, I personally, I think each of us look for different things in emails. One, I think that the email, I mean, maybe as an engineer, I am very used to thinking in bullets. So I really like emails which are not too verbose and all over the place. I think it's very, very important to crisply state what you're solving for, and to highlight maybe 3 to 5 key things that differentiate your startup. And when I say differentiate, again, I'm not saying, some fancy, it could be your IP or whatever, but it could be that, it could be that in the last 3 months, you actually grew 100% month on month. And by the way, 100% month on month very early in the startup is not fancy. It's actually like, going from 1 to 2 is already 100%. But the fact is that if you can really capture the attention with some really good numbers, showing your progress, showing the team, maybe you got on one of these marquee guys to invest or advise you, something, right? But don't make it too verbose, keep it very crisp, and not more than 3 to 5 bullets. And that's why this is more called what we like to call a teaser email, right? I think the first email has to kind of tease you as an investor and want you to ask you for more, right? Want you to make the investor reply and say, why don't we have a call, or send more information. So that's really how that's really how I usually kind of decide on which emails to look at and what attracts me. Maybe a little bit more biased with numbers. So I really like it when people kind of can talk about it in numbers. The next thing that you asked was about deck, right, Premnath?
Yeah. Yeah.
A 60 slide deck is, I think it is too much effort for the entrepreneurs as well, and definitely for the investors. Again, I think brevity is your answer. So, you know what, you have to realize that even as investors, you kind of, we peel the onion, right? So initially, as we understand the business. So initially, we really want to understand at a top level what you're trying to solve, who the team is behind the business, what is the larger landscape like, and how we're trying to solve it, like, top level business model, revenue model things. So then if you are able to get our attention and we think that this is interesting for us, it's an investment fit, the next level will actually be a lot more deep dive. So you can maybe, ideally what I would think is maybe have 2 versions of pitch decks. The first one is just the right amount of detail, answering questions about the team, the product or the service that you're providing, the business model, top, like partners, or basically top amount of traction and things like that, and how much you're trying to raise and where you are, right? So, something like, initial 1 or 2 slides each, so not more than 10 slides. And then have a deck which actually goes into a little bit more detail. And depending on the type of startups, my sense is that, we would go into, we would expect a different kind of detail. Now, if it is a deep tech startup, you may not be able to, have a 60 slide deck only on the product. But, I actually, again, am biased towards a demo. Anything I can see and try is way more valuable than anything I can simply read and reference. Yes, I would do the latter, but the former actually gets my attention a lot more. So I would actually kind of have a deck where, I have access to maybe a demo, which is kind of a link, screenshots, and then maybe testimonials of early users, customers, things like that. So the next deck can be a little bit more detailed. And as we learn more, we will definitely come back to you to get literally every aspect of the product or business model or the team clarified. So don't try to boil the ocean with a deck. I mean, that may be my little bit of advice.
Sure. Dr. Ramesh, I wanted to ask you about technology and IP, right? And your comments on it. How do you view them? And what are the kind of lenses you will put them through? What does it matter? To what extent? And so on.
Premnath, before I come there, I want to answer the previous question. I was trying to understand last 20 deals we did, whether any of the deals we have done came through cold emails or which came on our own proactive looking for, or some referrals. Probably it looks like 100% of the last 20 deals we have done or either deals which we have proactively looked for a particular deal or which came through strong referrals actually. So again, re-emphasizes the point that entrepreneurs should reach a VC through a common network who understands the subject.
Yeah, the importance of networks also there.
Yeah, absolutely.
Yeah, sure.
So coming to the IP tech, I think it's a very difficult question. For example, at least 2-3 companies we have in our own portfolio, my own portfolio, not the tech side, SigTuple and iStem, for example. SigTuple, actually, I was looking for 5 years back, AI in pathology. I was actually scouting for the various Hyderabad, Bangalore, Pune, Delhi. That's how I found this. And I know that pathology, even 5 years back, digitalization has to happen, AI has to solve. And there's an interesting book. Someone said, doctors with images, doctors without images. So radiology, pathology, dermatology, very amenable for AI because it's all image based. So we actually look for it. And obviously, as an early stage investor, if you are betting, okay, I need to have revenues, by that time it's too late. Already large stage investors will come in. So any early stage investor in deep tech or sciences should be able to have his conviction. This field is, I like it, and probably, and obviously you have to go at early stage. Obviously at that stage, product may not be there, regulatory approvals will not be there. So, but definitely IP, having said that, Premnath, we say, okay, this company has 6 patents, this company has 10 patents. We are not experts to really say how strong is the patents actually. We may take a second opinion from someone, but unlike the way academic institutions evaluate the IP, we may not, investors may not go with the same lens. Oh, this company has 6 IPs, that's fine enough, but will not be able to really understand this IP will really differentiate them or protect them from competitors. But definitely any science-based company or medical device company, some amount of decent IP, definitely a clear understanding of the roadmap to regulatory. See, regulatory also of late have changed. I think that's very essential, understanding the regulatory roadmap. Yeah.
Can I add to this, Premnath, or you have?
Yeah, please. But I have another. I mean, I wanted you to. You can add to it, but you can, if you don't mind. I want to request you to focus also on the cap table, which I know you consider. I mean, you're really sharp on that, but also especially cap table and indicators of traction. Okay, for the startup.
Sure. Yeah. So just looking at intellectual property versus patent.
Yeah.
You may have an intellectual property and you may not have a patent, right? At the end of the day, it's all about commercialization. Is there freedom to operate? If I have a patent, do I have freedom to operate? Yeah. So there are several questions that so I'm not very enamored by technology. I'm not very enamored by intellectual property. I am very enamored by dhanda. Okay. Are you in it to make money? Okay. And help us, add to that. So your ability to commercialize is more important than whether you have a patent or you don't have an intellectual property, right? So at the end of the day, it's all about brand building and, market. And when some founders tell me, they come to me for advice, they want to raise money, and I go to colleges to talk about, raising money. They tell me, look, I'm a technologist. I don't know how to sell. And I'm like, no, tomorrow morning, you have to become an expert in selling. What do you mean you don't understand, or you're a technology, you don't understand finance? So, you've got to kind of have the right kind of understanding. And, just to close that point on intellectual property, What was your question?
About cap tables and indicators of traction.
Awesome.
I know you can give a 1-hour lecture on it, but
I know it.
a brief version of it.
Is it okay if I share my screen or?
Yeah, sure, you can. Keep it brief. Yeah.
Okay. No, so let me, like I said earlier, this whole lecture on cap table is there in my LinkedIn profile under my featured presentation. But essentially, at the end of the day, what traction do you have? Yeah, and against that traction, because it's very hard, it's all about valuation. Yeah, so if you want to look at valuation, what is the traction against which I will look at a market multiple to arrive at a valuation? You are too early stage for me to look at your books of accounts and try and do some sort of a projection on to see your past is an indicator of future, etc. So it's very, very difficult. So the 5 things that I talked about earlier, the team, the market, the product, the traction and exit, one of them is traction. And based on the traction, you sort of say that, look, I'm raising 3 crores today and I'm giving away 25% of the company. Yeah. So that means I'm sort of valuing my company at 9 crores pre-money and so on and so forth. And if it's too technical, then I'll stop right here. But you have to look at what is your today's cap table, and as you raise money based on the traction, yeah, and how much are you going to dilute so that you don't dilute below 50% in angel round, for instance. I've come across deals where it's a fantastic team, damn good market. They're at a pre-series A level, but the founder team is down to about 30%. Now that's really bad, because we want the founders to make money. We want them to be able to control the board. We want them to be able to control, the shareholders meeting and so on and so forth. It's important to look at what traction do you achieve, and hence arrive at the amount of money that you need to give and how much equity you're going to give against that. So that, in a nutshell, is all about. I have a Excel spreadsheet example by which I actually talk about projected cash flow tables. Projected cap table. Where you sort of do a scenario planning to say, at Series A, I'll raise so much, at Series B. And that's because of my experience with one of the questions that I asked the founders is, you're raising this much today, and this is good for 18 months. What are you going to raise at the end of 18 months? I want to know that today. Because then I will make an assessment, how much more will you dilute? And so on. So that's the importance of a cap table. Cap table is nothing but a list of people who appear on your shareholders list, and how much shares do they hold and what percentage it is. That's all it is. But at different stages, these change.
Amitabh, when you see a proposal, what indicates to you that this startup is getting traction?
Okay, so like I said, there are a couple of things that you sort of look at to arrive at the key performance indicators that you want to look at. And these are basically 4 categories. The numbers, as Radha talked about, these may be financial numbers or they may be traction, daily active users, monthly active users. These are all traction. So the numbers, everything to do with numbers is one group of KPIs. The second is how loyal, what is the loyalty? What's the stickiness of your customers? What traction are you seeing on that front? The third is this good enough to scale? Yeah, with the amount of money that you are raising right now, is it going to scale or will it take a long time? And last but not the least are the traction and KPIs around the moat of the intellectual property. Is it commercializable and so on and so forth? Am I answering your question?
Yeah. More, when you say moat, I suppose it's also defendable, right? In the sense you can defend the moat, right?
So, absolutely. Yeah. And it's an engagement of, like I said, 3 to 10 meetings over which we will observe the way you walk, the way you talk, the way you dress. And somebody, not me, somebody will be doing a homework on, what does he do on the side, and we'll want to know everything about you. Okay, as I'm sure that they'll want to know everything about us.
A question to Amitabh. I know we used to have multiple meetings, 5-6 meetings. Don't you think last 6 months, 12 months, the pace of investment is so fast? Before you even call the investor for the second time, the deal is done?
You're right. You're absolutely right. I was talking about the traditional way of somebody not knowing the investor, not having met anybody else. most of the deals that I am getting today, frankly, are the ones in which my fellow VC people are actually saying, look, Amitabh, this is an area that I don't understand, but I like the founder. Would you look at it? In which case, I know that they have done homework on one part, so we can move really, really fast. Or if there's a term sheet on hand, then, so the term sheet has been issued by Radha. I know Radha. I don't, but I will soon. I hope that I'll soon get to know Radha. I will say, hey, wait a minute. If Radha's looked at it, I believe them, then I'll move really, really fast. So I have the fastest that we have issued, that I have issued a term sheet is 3 days. Okay, so it is, you're absolutely right. And I think Dr. Ramesh also said, and I have also maintained that just like you guys are trying to raise money, we are very, very keen to find deals to invest in. And the best deals are the ones where we are chasing you.
Okay, great. Mukesh, the topic for you is valuation and exit.
And maybe touch upon what is the deal breaker for you, Mukesh, and the same thing to to Radha and others as well.
Yeah, so I mean this concept is very popular in product marketing. Two questions you ask if you walk into shoes of the product. Maybe you have to do that as a company. Who am I and why should you buy me? Right? But as a company, who am I and why should an investor buy you, buy a stake in you? If you have clarity on that, and then I think your pitch deck, your email, your conversations, everything becomes very crystal clear. And increasingly, what we are seeing is aggressive expectation with a very poor business and financial case supporting the valuation expectations. So that doesn't go too far. So that's a red flag, right? The transaction or the conversation is not going to go too far. The pie of stake in your company is fixed at 100%. So you need to increase absolute value for each piece, right? So rather than valuation, it would be best to focus on value creation. And are you distributing that value fairly between different stakeholders across different rounds? I would probably like to say that there is too much hype in the market today. And what we read in the newspaper, many times you see entrepreneurs really follow that, and I'm increasingly seeing entrepreneurs give those examples. So yeah, we would definitely not do a transaction in a very short period of time. We would not compete or get rushed into a transaction. No investor wants to have a large stake in poor or underperforming business, right? Most investors would be happy owning a small piece of a successful business as far as their return goals are met. And valuation is linked to assumptions, right? You can always create structures to reward or compensate the affected party in a way where valuation differences become redundant. Let's look at an example. Let's say an investor thinks that the company is worth 100 and the promoter thinks that it is worth 200. Who's right? Both are pricing a financial asset based on their assumptions of the risk and the opportunity. Right? Promoter is seeing value for the opportunity that they've unlocked or they believe they can unlock. And the investor is seeing bigger risk and wants to price that in, right? That's why you are seeing that difference. Now, there are many ways you can structure this transaction. You can structure the transaction at 200 and compensate the investor if the risk plays out. Because you're not pricing in that risk, but the investor wants to. You are going to have a better chance at getting that transaction done. But if you stick to 200 without de-risking the investor, there's a possibility you may lose out. You can also structure it at 100 and reward the promoter if the opportunity plays out as if the transaction was really done at 200. Or you can go find a counterparty where the opportunity and risk perceptions are not that wide, right? So I would actually say that, if you are sensing that you are talking to a right investor who's going to be a good partner for you, is going to add value to you, don't make valuation the deal breaker because you can make it redundant. But yeah, I mean, there is no way you're going to get what you want without really addressing the concerns of other party. Also, remember at early stage, we are taking decisions with a lot of uncertainty, risks, and range of possible options. So it really comes down to understanding the risk return trade-offs, right? And as early stage companies, early stage tech companies, longer the idea, product, commercial, launch, scale, profit cycle, the longer your startup death valley curve, right? With deep chasms, with many challenges that you're going to face. So amount of capital needed to cross that valley of death is also important. We have funded 3 medtech companies from the idea stage, and we've seen them, go through these ups and downs. The only way we were able to, this long gestation cycle, the only way we were able to really support them throughout that was this incubator fund continuum. That really helped us deal with this long gestation. We were able to unlock full range of grants, equity, soft debt funding, with many of our LPs and wide range of ecosystem partners providing necessary product, regulatory, clinical, and business support. So, yeah, so I think you need to look at some of those aspects and make sure that you are making both the opportunity and risks very clear in your mind, and then you are de-risking for the investor to come in. The big red flag for us is many times when entrepreneurs are just having a very unidirectional thinking, saying, okay, I am worth X million dollars. Let me just find the investor who gives me that valuation. Even the investor who doesn't believe in the pitch that you're making or the value that you're seeking might end up adding a lot of value to you if you constructively engage with it. You may not have, if the gap is big, you may not have many engagement points, but it can really get you back to the drawing board so that your next investor interaction is positive. We'll pause here and see, Satya and Premnath, if I address the things that you wanted me to.
No, I think you have. Satya, we are at 6:40. So tell me, do you, so sorry for, it's a little behind schedule, but if you don't mind, we'll just move into the next segment quickly. And I just wanted to request each of you on a few other points. First of all, each of you have chosen a particular instrument to use, CCPS or CCD or equity and so on. Can I request Radha to talk about how an investor thinks through which instruments they want to use and what are the implications of that? And then I wanted to request others to comment on post-investment issues in terms of what happens actually when you're engaging with a startup post-investment, and what is the expectation, what should the typical entrepreneur be prepared for, and finally we'll close with some advice from each of you for the startups. Okay, so Radha, can you comment a little bit on the instruments that are being used and what are what is your thinking behind it, and what are there negotiations, arguments around that, and do you have some views on that also?
Sure. So I think most of us on this panel invest in what is called the preference shares or CCPS. I think Dr. Ramesh mentioned this briefly. This is called compulsorily convertible preference shares. I won't get into the technicalities of it, but fundamentally there are shares, classes, let's say there are 2 classes of shares. We'll not get into debt instruments. We are talking about equity investments, and this is basically shareholding in the company. Debt is completely different. That's another way of investing in a company, but it is a superior instrument in the sense that you get paid back with a certain amount of interest, but you don't have a place. It is not dilutive. So you don't have a place on the company's cap table. So the company does not give you shares for the money they take from you. So we'll keep debt separate. From a equity standpoint, there are really fundamentally 2 types of shares. One is common shares. And when you say common shares, typically they don't come with a lot of rights along with for the money that you invest. Now, sometimes early angels will most likely invest in common shares. So what it means is that if I come into a company very early in the stage of the company, so maybe they raise money from friends and family, they will get shares typically at par value, but there may not necessarily be any rights available to those shareholders. I'll come to the rights very quickly, but most of us as investors, whether it is angels writing large checks, either funds which are venture capital funds or even private equity funds, will invest with a certain set of rights that we want in exchange of the money that we put in, along with the shareholding we get. So what that really means is that two things. So one, so our shares come with, for example, different voting rights when compared to the voting rights of equity shareholders. So we will want to have somewhat of a say in a few aspects of the business. So for example, one of the common things is that we want to be able to weigh in on the company's usage of those funds that we invest in the company towards, let's say, capital expenditure. Right, and there will typically be some kind of a term or a right which says that this has to get approved. Anything beyond a spend of, let's say, 5 lakhs or 50 lakhs, depending on how much is the fund that's being, how much is the money that's being invested in the stage of the company, has to get an approval from the board, and the board representation also is a right? So typically what happens is we will have superior rights compared to common shareholders, and the rights will give us an opportunity to protect our downside in the company, and it kind of compensates us for the risk we are taking in investing in the company. Common rights, I will just talk about maybe 3 of them. One of the important things is called liquidation preference. And I think, the founders should maybe do some quick reading up. It's very straightforward. The idea is that for every dollar the investor invests in a company, we want to be treated differently, senior to, let's say, the common shareholders, whenever there is a liquidation event. Now you have to understand that as financial investors, we are investing in the company with a key purpose of generating superior financial returns for the capital invested, right? So at some point, we want to exit from the company. And when we exit, we want to be able to exit with a certain, we want to be able to exit without too many conditions or strings attached. So what I will have as a liquidation preference is that I say that I put in $100 in the company. Whenever the company, let's say, exits through or rather whenever the company liquidates, maybe the company gets acquired, from the proceeds of that acquisition, as investors, we want to, early risk takers, let's say, we want to have the ability to get our capital out first based on the preference. Right. So that means that the $100 I give to the company on acquisition might actually come to me before everybody else gets the proceeds from the liquidation. Just I'm trying to simplify it.
That's fine. Actually,
I hope
that's
it's
good.
So basically, liquidation preference is one of the key rights that we get as preference shareholders. There are also a few other rights which are important. We typically, as majority shareholders, initially, when I say majority investor shareholders, not greater than 50%, we typically want to have voting rights on some of the key, like I said, business decisions. So we will typically also take seats in the board, director seats on the board, and we also want to be able to veto on decisions that we think are not in the interest of the company and the business scaling. And there are a couple of other rights which has to do with anti-dilution and things like that. So I won't get into those details, but broadly, we have superior rights, and that's what preference shares give you versus equity. I'll just pause here. I don't know if this is too much for everybody.
No, I think that's very helpful, and hearing it from you, there are different insights also on why an investor thinks to that. Can I request maybe Dr. Ramesh to talk a little bit about the post-investment scene, right? What do you expect from the founders? What are the basic broad expectations? What are flags, red flags, and so on? There are situations when sometimes investors feel that the board is not really functioning appropriately, and so on. Do you want to comment on that?
Hello?
Yeah, we can hear you.
I think I lost you. Basically, you're saying post-investment, what are
Yeah.
the do's and don'ts?
Yeah.
Sure. I think what is minimum expected, most of the early
You can shut
is
off
have
your
a
video,
monthly
please.
meeting.
Can you
with
cut
the
off your video, Dr. Ramesh? Yeah, I think sound seems to be coming okay. Can you hear us?
Yeah, I can hear you.
Yeah,
Is
go
it
ahead, please. Yeah, now it's better. Yeah.
Sure. Post-investment, what early stage investors expect is a monthly meeting and a formal quarterly board meeting.
Yeah.
Also, in the monthly meeting, it's always a good idea to sit with the investor and decide the format of the board deck. What I would say is the MIS, Management Information Systems, and because many times it's always good in the early stage itself, what exactly needs to be covered. What are the, if it's assuming it's a product company, the product roadmap or the regulatory roadmap or the go-to-market strategy. So it's always a good idea to develop a good MIS framework or a monthly information what the investors want. The second point is always many entrepreneurs I see in the initial stages, they're little try to be diffident, try to hide the information. So my sincere request is once the investment is made, the investors and the entrepreneurs on the same side of the table, they're not on the different side of the table. It's absolutely a good habit to be as frank and as honest. And in fact, good things, bad things should reach the investor first rather than the good things. So try to have a very open relationship with the investor and communicate. Over communicating is always better. And in addition to that, Premnath, early stage companies need a lot of help. Most of the VCs do that, whether it is the team hiring, whether the strategy on the product development. As we touched on the subject before, networking helps. Many people need help on the regulatory. Not that we are experts on the regulatory. Mm-hmm. With our connections, we can always connect to the right people. So to summarize, the entrepreneurs should sit with the investors, decide the framework, the reporting format early in the stage so that it'll be easy, no communication gaps. Second point is communicate regularly with the investors. Investors are not on the opposite side of the table. They're like you. The success of the company is equally important to both of them. These are 3-4 tidbits. And
sure. Yeah, did you want to say something more?
No, I think in fact, while these monthly meetings are mandatory, quarterly board meetings are mandatory from the regulatory point of view. But many times we are in the WhatsApp group actually. Mm-hmm. The founding teams and 1 or 2 team members from the investment community, they're always in the WhatsApp group. It's almost a daily actually. And this decreases over a period of time actually. It may be very intense first 3 months, 6 months. Later, once there's an understanding of both the sides, the frequency of interaction goes up. And obviously, when the next set of investors come in, the early stage investors, definitely the interactions can come down significantly.
Okay, great. That I think, Mukesh, can I request you to speak a little bit about again how the board can help, and also a little bit about co-founder issues, disputes, handling of that, because one of the things we hear a lot about is that there are a lot of co-founder disputes, and that's one of the top reasons for companies failing as well. Is that so? And how does the board help?
How many housing.com you want, right?
Yeah, no, I think we have seen quite a few of these. If I look at our incubator portfolio, our co-investors are fund together between them almost 70-80 companies, and I would say we would have seen these issues in probably somewhere between 10 to 20% of the companies with varying degree of intensity. But more often than not, it destroys value for everyone and makes the life for founders miserable. But unfortunately, what happens is many of the safeguards that the founders can put in place, for example, vesting of equity, that is one of the most heavily negotiated clause, though it protects the founder and the company, not the investor. They believe that it's protecting the investor, but not them. So that's one issue. So I think, really understanding which of the clauses in a term sheet are helping you and which of those clauses are affecting you, I think is important, and not to over negotiate on some of the things which are probably going to protect you. I think detailed business plan, role clarity, schedule of authority, performance-based culture, and robust governance. I think these are 4 or 5 levers that you can use to address co-founder issues. Most cases, I think it's lack of role clarity, authority clash. I think that's where it emerges. And many times, friends coming together, not having clear communication about how their performance will be assessed, and not really asking hard questions to each other. Sometimes you probably can have the board do that, right? Have the board assess promoter, performance. So Satya and Premnath all linked to the board, and what we have seen is, in the early stages, maybe even later stage business, not only early stages, the governance and fiduciary maturity in the startup ecosystem have been relatively low. Resulting in a gut-based and emotional approach to important institutional decisions. So it is very important to not approach board formation from compliance and control mindset. There are a lot of literature in public domain on this topic. So empowered, it's very important to have empowered board. You can actually have, people with great pedigree, but if they are not empowered, or if they're not independent, or there's no diversity, then, that governance suffers a bit. It also reduces reliance on, if you have a good board, it reduces reliance on ad hoc advice from people who are not close to your business and may not be as attached to your business outcome as a formal board. Mm-hmm. And one last point that I would make, not on the board and the co-founder issues, is you wouldn't drive your 2-wheeler or 4-wheeler without really looking at your dashboard. But you will see many startups not having, Dr. Ramesh talked about MIS, not having it in place. Right? It's a big red flag. Amongst many other challenges, there is really a low-hanging fruit that you shouldn't leave open for too long. And most investors that you deal with, you need to understand that they are managers of capital. They're not owners of capital. Right? So they also have their own fiduciary duty and reporting responsibilities. So if you don't create infrastructure, don't share information in time, you're putting them in difficult place and creating an avoidable tension with your board and investor, which will hurt your chances of getting probably more capital from existing investors in the next round. That's it from me.
Just one question about how do you view family members being co-founders?
It's I mean, at the early stages, it's very difficult to attract talent. So that's why it ends up happening. But if you create a merit-based system, if on the basis of merit they have a role in the team, very clear role in the team, and if their performance is, their engagement with the business is performance linked, then I think it's less of a problem. But you rarely see that, Premnath. So that's why you see these issues. So I think focus on merit and performance, and if there's a family member, if you don't see a role for them, probably moving them to non-executive roles rather than just insisting for emotional reasons to have them around. I think you should probably address that early on.
Sure, thank you, Mukesh. Amitabh, a few important topics to close on this segment. One is next rounds of investment. Okay, how does an investor progress a company towards further rounds of investment? How do you view it? How do you also view a company going overseas? Okay, having a base elsewhere, raising money internationally, and how do you view partnerships which could lead to acquisitions, or vis-a-vis a sale of technology or sale of some assets from the company, right, as an investor? You're on mute, I think.
Thank you. So the last one first. I mean, obviously we want our equity to be valued and be sold. We are fund managers, and there's a life to the fund. the last thing we want to do is at the end of the fund, instead of giving the returns to the investors, we are giving them shares of the company in which they're holding. So obviously the preferred route is to not do a slump sale, and to, unless it's, if it is required, then you do it. But basically you're trying to build value into a company. The value is reflected in the price of the share, and you want to make sure that those shares do get sold. So that's the last part of your question. Remind me of the first few questions, please.
Yeah, it's more about taking them to rounds of investment, exits, technology sale or asset sale in between, how you view it, because there will be companies which are sitting on technology which they might want to, there might be corporate buyers for it as well, especially in deep tech companies, right?
Corporate what?
There might be corporates who want to buy technology, for example, right? And that is an asset sale. So investors may or may not see that as as something favorable.
So the question is,
and sorry, and Amita, one more point is, if you see in a deep tech company, there is one part of the business model they might be doing as say revenue generation. The other one is pre-market. There's still a product being developed. The other one is maybe a contract research that's happening as a consulting or whatever.
Got it. Good question. So alignment of all the assets in the company towards a single buyer is a desired outcome. So let me explain what I mean by that is, if let's say I have a CRO, right, and I also am trying to build some intellectual property. Now, from the point of view of an exit, since beauty is in the eye of the beholder and it applies across everything else, in comes Eli Lilly and says, I have no interest in your CRO. Okay, I just want to buy this molecule and that's the end of it. Right. So it's okay in the very, very early stage to generate cash so that you can fund it, but you have to decide which is the way you're going. Yeah. Are you going to go towards just the cash flow, which is a services business, not really building value which reflects into the price of the share? Because, services industries are valued at 0.75 to 1.5 times the revenue. It's nothing, right? Whereas an intellectual property could be worth a whole lot. So you have to kind of decide and maybe divide the company into two. So this goes back into the structuring of the engagement, to answer your question, Premnath. So it's not a real smart. You have to align all the assets in the company towards a single buyer. Yeah. If you are a company that's constantly creating intellectual property, then you have to think about spinning that off and then raising the capital in the spun off entity. Because where is the value in the company? And then how do you reward those investors who've invested in it in the early stage? There is a limit to the life of the fund. So at what point are you going to give an exit to the investors? So that's really the key question.
Yeah. And how about going out overseas? Do you have any comments on that? To raise and sometimes there's flipped structures in ownership and so on.
Yeah, so I mean, it's a long question. It's something that's very, very relevant in these days, because there is one group of people who say, no, we should build for India, build for the world. So why do you need to flip over? Is one question. The other is, you have to sell your assets where you'll get the maximum bang for the buck. So that sometimes require you to flip the company over, because many a times a foreign entity which is trying to acquire you may not want to acquire an entity here in India. So you might want to flip the company over, which is, it's a complex thing which I completely don't understand. My CFO partner will be in a much better position, or one of the other panelists can talk about it. But flipping the company over, it's very early to recognize where the exit might come from. Many of the life sciences, pure drug discovery companies may find the best bang for the buck outside of India. Maybe in Europe, maybe in the triangle in North Carolina, or maybe Boston. So you kind of recognize all of those pretty early in the stage. Speak with your investors. Go to the investors who have connections to make this happen in the first place. So they'll probably help you decide on some of these things. So it's okay. to look at. Is that the answer to that you're seeking?
Yeah, no, that's good. I do understand there's a lot more in it which needs to be discussed. We may not have the time today, but I think we'll now come to the last segment. I'll request Satya to take over. That's where you get to give your gyan, right, to all our startups. Satya.
Correct. I think 2 hours we have been absolutely listening as actively as it was in the first 10 minutes. At least for me, it is. So let's wrap this up. Before we wrap up, I think I know we've taken almost 2 hours, but let's take a group picture before we wrap up, or maybe we'll take the group picture in the end. So last points from the panel. The sentiment currently in the market. I think, Radha did touch upon it, saying that she's seeing bloated checks, or somebody said about 50 million checks. And also good point I wanted to tell the cohort that, see, even this platform, we brought together Amitabh and Radha to say hello to each other. They hadn't said hello to each other until today. Right, so do not underestimate, the power of platforms and networks and getting associated with it. So that's I wanted to point that to to the cohort. We'll do a session on networking, as Premnath had mentioned. So 2 points to end from each of the panelists. What is the current sentiment? And do you think we have now come to a stage where real deep tech, so what's the current sentiment? Have we reached a stage where we can really entertain real deep tech in India, right? Which have long gestation period, maybe 7 to 10 years. And how do you think COVID has changed everything? So these three, maybe a minute each, and then we will close.
And your 1 point advice to startups. Go ahead.
And your 1 point advice to startups. Shall we start with Mukesh this time, then Dr. Ramesh, then Radha, and then Amitabh?
Yeah, I think sentiment seems very positive, bullish. Wherever you see, there's just a lot of liquidity in the market. I'm not sure if that is good or bad. We're just trying to keep our head down, focus on impact and outcomes, and not let the hype, take over, and don't want to really be part of it. So focusing on core things, outcomes, impact. I think we'll just continue to do that. Long gestation companies, Premnath knows I visited Venture Center in 2011, and we did something together even 10 years ago. So we have done that. We will continue to do that. That's why we are part of this ecosystem. So I don't think external environment will make us go faster or slower. So we have done that and will continue to do that. Advice for startups would be to, get the basics right, get the right investor, and eliminate information asymmetry. Like, I'm trying to keep my head down and not be part of the hype. Just stay out of the hype and just focus on the basics. That's it from me.
Sure.
Thank you, Mukesh. Radha?
Yeah, so I think one of the biggest questions that was plaguing our ecosystem was exits. And I don't know if we celebrate all the writing 50 million checks with one meeting, but I definitely think it's a great time now, especially with the Zomato IPO. At least the question around exits and liquidity in the ecosystem is somewhat beginning to be addressed. I think the ecosystem is becoming a little bit more deeper and more mature. So only time will tell how these IPOs perform. So I do hope that it's a big positive for all of us, and many more of these companies which are lined up with their DHRPs do really well in the Indian bourses. I think the question around deep tech ecosystems, Satya, to be very honest, the depth in the Indian investing side is still not there. I still feel like there are few investors in the Indian ecosystem who understand deep tech well enough and have the ability to, first of all, evaluate and support the companies well enough to take them to the next stage. I can definitely tell you that there isn't that much capital to support really value, like really big deep tech companies, whether it is biotech or it is anything else, right? I think post Series B and stuff, I just don't see the ecosystem, deep enough. That's why a lot of the deep tech companies are, I think Amitabh touched this briefly, are actually better off, finding investor partners who are outside India, maybe in the US, maybe Europe. I think these ecosystems understand, deep tech better than we do. Just my impression of where we are. And the only advice maybe I will give entrepreneurs, or rather the folks on this call, is funding is only a milestone. It's a means to the end. Don't think of it as, a big, I've arrived if I've raised money. I think the goal is always to build to last. I think those companies which actually can, build businesses, take products to the market, make a difference, a meaningful difference to millions of lives. I think that's really what we want to build. Don't view funding as like a great thing. But yes, it's a great time to be an entrepreneur.
Yes, definitely.
Thank you, Radha. Dr. Ramesh?
Yeah, I think it's big reputation, but anyhow, too much money is chasing good startups. Money is not an issue anymore. And the second point is entrepreneurs and investors are on the same side of the table. That's the second point. And third point is deep tech startups. Still, I think the challenge for follow-on funding, even though some of us are doing early stage deep tech investments, I think we still are finding it difficult to raise the follow-on capital. Having said that, probably I'm always an optimist. Things will change.
Thank you. And Amitabh, your last words.
Yeah.
For this
no, so I think everybody has pretty much said everything that needs to be said. On what really excites me about what's happening in the industry, apart from a lot of spare capital which is hitting the market today, is the geopolitical situation. I think it's very, very favorable for India. I don't want to name any countries or any of that, but it suffices to say that this is a fantastic time for a lot of the capital to come from the markets where, from investors who are in the markets where you want to ultimately make a sale. So it's a very, very good situation. On deep tech, I do completely agree with what Radha said and what Dr. Ramesh and others have said. But my own feeling is that not in every case, but you should look at in a 15 to 20 year period for a deep tech to really materialize, or deep tech or deep science or whatever that might be. You should look at what milestones are there which become fundable. You as the founder should go and do the homework to figure out, are there intermediate fundings that are possible? Not in every case, but if it is possible, then you should try and see if there's a milestone funding. My worry is that in the milestone funding, in the earlier milestone, the return, the IRRs are very, very low for the investors. And that's why I think Radha made the point that, it's the IRR which doesn't make. The last thing is, what my one sentence to all of you is, believe in yourself, believe in your business, but keep your eyes open.
Wonderful. Thank you, everyone. I think this really calls for a big round of applause. So from me, definitely to the panel, thank you. Radha, Dr. Ramesh, Mukesh, Amitabh, and Premnath. We also run a venture center, the Direct Seed and Equity, and there's an ACE fund as well. We haven't touched, maybe we'll touch sometime later. So time for a picture. I think Chintan is also around. And I see Manisha, and then we'll close after the picture. And I think there are three pages to this Zoom. So Anmol, you will have to click thrice and then save it.
And you have to tell us when to stop smiling, okay?
Premnath, you can switch on my video.
Yes, please. Oh, just 1 minute. Where did it?
Or some other host.
Yeah. I'll just.
Premnath, my video also.
Oh, did I switch it off?
Chintan
Sorry.
is in the car.
Did I switch anybody else off? Sorry.
Pick me when there's good light here.
Oh, yeah.
Okay. I think we are okay now, right?
We are okay.
Yes. Okay. Shall we? Anmol, are you taking the pictures?
Yeah, we're good. Thank you.
Thank you.
Thank you, everyone. And
Thank
again,
you.
thanks to all of you. And Chintan, thank you for joining, despite the fact that you are driving and it's quite late in the evening. So panelists,
Oh,
thanks
thank you.
again. I'll be in touch.
Thank you.
Thank you.
Thanks. Great job, Premnath and Satya.
Great job,
Wonderful
Premnath.
panel.
Very good. Satya.
Thank you.
Mumtaz.
Thanks so much. Really enjoyed it. I think a lot of learning, a lot of insights, direct insights. If I said the same things, nobody would believe me. So, so it's important you say it. Thank you so much for taking time out. Okay.
Thank you.
We'll stay in
Thank
touch.
you.
We'll keep you informed as well. Okay.
Thank you.
Bye.
Bye.
Bye. Thank you, everybody.